And we're going to talk a little bit about rebalancing. Okay, so why do we rebalance our portfolios? Well, three reasons really. The first one is risk control, right? You're returning the portfolio back to your desired amount of risk you want to take in the portfolio. The second one is it's possible to get a rebalancing bonus, right? You know, in investing that you're trying to buy low and sell high. But rebalancing actually forces you to do that, right? Because you are putting your money toward what has done most poorly recently. And so you're buying low. And sometimes you have to sell something to rebalance. A lot of times you can just do it with new money, but sometimes you have to sell. So you're selling high and buying low. And the last thing is it gives you something to do with your portfolio. For those of us with these know nothing, set it and forget it, static asset allocation portfolios, like we know we're supposed to have, it gives you something to do. And I think that's good because it keeps you from tinkering with the investments. Because you're like, oh, all right, I get to do something. I get to rebalance the portfolio. And so I think there's some benefit there. So there's really two schools of thought to when you rebalance your portfolio. The first one is you rebalance it based on time. This is the way I rebalance my parents' portfolio. Every year in the spring, we rebalance it. You know, if it's a little out of balance or whether it's a lot out of balance, we rebalance it. I think it's usually April or March that we do it. And so you just do it based on time. Maybe your birthday, maybe the end of the year, whatever. That's the time when you rebalance your portfolio and you bring it all back to the original percentages that you set up in your written investment plan. You know, maybe that's 30% US stocks, maybe that's 20% international stocks, maybe it's 10% real estate, and maybe it's 40% bonds. I don't know. Whatever your asset allocation is, you should have those percentages written down and you rebalance back to those percentages. This is just a little spreadsheet problem, right? And if you don't know how to use a spreadsheet, open up Excel, open up Google Sheets, figure this out. It's not that complicated. If you truly can't figure it out, if you cannot use a spreadsheet, you honestly have no business managing your own portfolio. You need to go hire a financial planner. We have a list of good planners, good investment managers at whitecoatinvestor.com/recommended. You should hire one. But it's not that hard to figure out a spreadsheet. I mean, you got through medical school or dental school or law school or something. You can figure out a spreadsheet. You don't have to know everything about Excel to figure out a simple spreadsheet that will tell you how much to buy of one thing and how much to sell of another thing in order to rebalance your portfolio. All right. The second one, right? One is you rebalance based on time. The second one is you rebalance based on events. For example, your portfolio gets so out of whack, that's an event. Now it's time to rebalance. Okay. So here's how it works. You know, a lot of people use what's called the 5-25 rule. So if any asset class is out of its target allocation by a gross 5%, right? So if you're saying you're supposed to have 30% in US stocks and you have 35% in US stocks, that's a trigger to rebalance the entire portfolio. The 25 part is a relative 25. So for example, let's say your portfolio calls for 10% in REITs, okay? But REITs have fallen in value more than 25%. So you now only 7.4% of your portfolio is in REITs. It's time to rebalance the portfolio. So those are kind of the two schools of thought. As far as time goes, you're not supposed to actually do it that frequently. The studies show that the best frequency for rebalancing is actually every 1 to 3 years. So you don't have to be doing this every month. It just doesn't matter that much. And you're probably hurting yourself. You're losing a little bit of the momentum of a typical asset class. Okay, so how do you do it? Well, first of all, it's generally not a good idea to have the exact same asset allocation in all of your accounts. You don't want to rebalance your accounts individually. You want to look at it all the money geared for retirement anyway, as the whole enchilada, one big portfolio, and do it all together. Step two is make the chart. You know, make the chart in that spreadsheet, right? Maybe one column lists the asset classes, the next column lists your target allocation, the next column tells you your current allocation, and then the final column tells you the amount to buy and sell. And then the next thing you do is you got to do put in the actual trades to rebalance. The first thing to consider, especially if you have a taxable account, I guess only if you have a taxable account, is any possible tax losses you can harvest. If you have money that is in a taxable account that has a loss, you're probably making a mistake. You should sell that investment and buy one very similar to it, but not in the words of the IRS, substantially identical, right? And capture that tax loss. You'll find that useful on your taxes. Up to $3,000 a year of capital losses can be used against your regular income, and an unlimited amount of capital losses against capital gains. Um, and then the next thing you do is you use new contributions. And I'm halfway through my career, maybe more. I'm still just rebalancing with new contributions. I almost never sell anything to rebalance. I just aim the new contributions at whatever isn't doing very well. And you can do that, I'd say most of the time, certainly in the beginning, your contributions are going to be enough that you can do that. The next thing, particularly in a taxable account, if you don't reinvest your dividends and capital gains, you can use that money to rebalance. You do need to be careful about the costs of rebalancing, right? If you're paying a bunch of commissions to do this, you want to minimize how often you're doing it and beware of taxes. Of course, when you can, you want to rebalance inside IRAs and 401ks, tax protected accounts, because there's no tax consequences to buying and selling there. Whereas if you sell something with a gain in your taxable account, there can be a substantial tax cost to doing that. Okay, another thing to keep in mind with this rebalancing is don't go crazy about perfection, okay? Because the day after you rebalance, you're not going to be perfectly balanced. So does it really matter if you got perfectly balanced the day before? It really doesn't. Okay, so just get them back close to your original allocation. Really, a portfolio that's 60% stock is not going to perform significantly differently from one that's 61% stock. All right, so you don't have to go too crazy about doing this. You can also take advantage of automation. For example, if you only have a single investment account, all your money's in a Roth IRA, for instance, you could use something like a Vanguard Target Retirement Account fund or a life strategy fund that will automatically do the rebalancing for you. Now, I wouldn't recommend that in a taxable account, but in a retirement account, it works great. And you never have to do the rebalancing yourself.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.